The Union budget for 23-24 was a 4C budget, which focused on consolidation of the fiscal, consumption, credit, and capex. On consolidation of the fiscal, which is a very well taken measure, especially from a bond market perspective, the finance minister suggested that the current fiscal deficit would be 6.4% of GDP, progressively going down to 5.9 and eventually going down to less than 4.5% by FY26. Now this, as I mentioned, is taken very well by the fixed income markets, and hence you saw that there was not much change in the bond market yields in the very next day post the budget, and yields pretty much remain stable as of today. The other important aspect was consumption. There was obviously no change in the overall taxation, but what the finance ministry did was it ensured that under the new regime, there was a tax rebate up to 7 lakhs, which obviously keeps a lot more money in the hands of the taxpayer. The third aspect is credit, and there was a massive outlay for agricultural credit of close to 20 lakh crores. There was also some SOPs built in for the MSME sector. So both these, we believe, will augur well for not just that particular sector, but for the finance sector in general. The last aspect was particularly interesting, which talked about capex. Now this, through the largest ever outlay of 10 lakh crores, which is an increase of 25% over the previous fiscal into capex. Now there is a lot of plan being built into creation of mega cities, urban infrastructure, railways and roads, and we believe this will augur extremely well for not just that sector, but a whole host of allied sectors as well. Overall, a very, very prudent budget, fiscally prudent as well, and we believe at the end of the day, this will augur very well for equity markets, not just for this year, but for the forthcoming years. And hence, to that extent, we believe that for investors who are looking at putting in incremental investments, they should look to stagger their investments out over a period of time, but you could still put 50% in lump sum, because in the current juncture, our temperature gauge index, which is our valuation barometer, states that we are in the fair value zone. The bias should continue towards multi-cap strategies. On the fixed income side, as I mentioned earlier, the yields are fairly stable, but at the same time, it is very attractive. In fact, fixed income is probably getting far more attractive today than it was about a year or so ago. Yields across the curve are hovering between 6.7 at the 1 year to close to 7.3% at the 10-year curve. In such a situation, we believe it would be very, very prudent to have maturities between 4 to 5 years as the core allocation to your portfolio. So hence, largely we believe that the core should be centered around mutual funds, which are more in the line of target maturity funds with the highest amount of credit quality to avoid taking any kind of credit risk, but at the same time maintaining prudence towards risk and reward. The other aspect that we found was in terms of some opportunities which had an adverse taxation with respect to some of the insurance plans, the traditional insurance plans, which will face a taxation on any policy which is over and above 5 lakhs issued with effect from 1st of April 2023. To that extent, a lot of investors who want to plan long-term cash flows through such plans have a window of about 2 months to take the benefit of such traditional insurance plans. At the same time, the other aspect was market-linked debentures, which will be taxed as the same as a normal NCD with effect from 1st April 2023. To that effect, we believe that those who are probably going to miss that opportunity of market-linked debentures going forward should ideally put that monies to work either into a multi-asset solution, which can be a superior alternative to fixed income. To that extent, we have a great solution in the Delphi managed solutions platform called ASAP, Alpha Strategist Advantage Portfolio, which is basically centered around 5 different asset classes, which is basically US equity, Indian equity, gold, long-term debt and short-term debt. Now this is rebalanced at the end of every year, and this ensures that you have a very smooth linear curve of return with volatility which is kind of suppressed. So this is a great alternative for fixed income markets. Apart from that, you could look at high RE NCDs, and for those who wish to take slightly higher risk can also look at the private credit opportunity.